The professor who teaches accounting at Harvard Business School for accounting was amazed at the cloud-based accounting systems. He was totally amazed at it. So he was saying, I can't believe this. I can't believe I didn't know any of this. The place where tax is going to mess up a startup founder is an 83B election. You miss an 83B election, there is no way to fix it. There's no easy way of getting around the 83B election. So it's kind of in the intersection of law or legal and taxes where most of the stuff can get bad. You hire a software engineer and you're paying that person $200,000. And so the first bite of the apple is you get to take that $200,000 as a tax deduction, and you'll get 10% of that $200,000, $20,000 in cold hard cash, free money, non-dilutive money. It's crazy not to take it.
Welcome to Tech Finance. I'm your host, Sasha Orloff, repeat founder and current CEO of Puzzle, and self-professed finance nerd. On this show, we dive into the pulse of B2B fintech, from newly funded startups transforming the office of the CFO to major industry shifts, deals, and partnerships that are reshaping how we think about finance. You'll hear the most important developments, essential analysis, and of course, AI innovations. This show is brought to you by Puzzle and the Turpentine Podcast Network. Let's dive in. Hi, everybody, and welcome back to Turpentine Finance. I'm your host, and today I am thrilled to sit down with someone who probably doesn't need any introduction if you are in the startup and tax world, Joe Faris, founder of Accountalent. And I had to hit record really quick because Joe was giving off all the good stuff in our pre-roll warm-up. So I'm just going to dive right into the good stuff. Joe has helped over 5,000 startups navigate this tricky world of tax and accounting and finance. Comes from big firm strength, small firm service. He's the real deal. And today we are in for a treat. This is going to be a masterclass for all you founders out there. Just for context, he has done at Harvard, MIT, University of Chicago, mentoring students and teachers about startup tax and accounting issues with over sort of 1,000 people, I guess, over the years, you say. All right, so before we dive in, I'm excited to share this with you. Joe's like one of the genuinely most like positive people I've ever met. And so I'm excited to get to share Joe with all of you. Joe, thanks for joining us.
Well, thank you. Thank you for those kind words. And thank you for inviting me.
All right, let's go in. Tell the audience a little bit about your background and what led you to the love of all things accounting and tax.
Accounting was kind of like a lot of stuff in my career was just kind of accidental or lucky because when I enrolled in college, I didn't know what I wanted to do. And I did a business major, and accounting alphabetically was the first one listed. So I just checked it off. I didn't know much about any other major. So I just stuck with it. So that's how I ended up being an accountant.
That is amazing. And I love the honesty of it. You scroll down the list, you start at the top, accounting. Great, let's go. All right, so let's maybe do almost like a punchline. You came to start Accountalent, one of the largest, most successful, most popular startup accounting tax services. How did Accountalent come to be?
Well, I was about 10 years into my professional career. It was the mid 80s. I had worked for Shell Oil Company when I came out of college and worked out in Houston, Indianapolis, and Ohio, West Virginia, and they kind of move you around. And then I was visiting my parents in the Boston area. I grew up in the Boston area, and I met my wife to be. And we started a long distance relationship. And we know that long distance relationships, eventually someone needs to make a decision. I made a decision to come back to Boston. And I came back and looked for a job. At the time, I was a card carrying accountant. I was a CPA. I took the exam. I passed it when I was down in Houston. And I ended up working for a startup. And I wanted to work for a startup. I ended up being CFO and controller of a small networking company. Now, let me just go ahead and paint the picture a little bit on what's happened in the mid 80s. In the mid 80s, in the Boston area, things were really booming. It was, we had a company by the name of Digital Equipment Corporation, and my wife was working for them actually. And it was a local company that did good. The first venture capital firm in the country was a company by the name of American Research and Development Corp. They were formed in, I think, 1946. And they were formed to capitalize on the technologies that were being developed for the growing economy and the growing population post World War II. And the fellow who was running there was a fellow by the name of General George Durant. And he's considered the father of venture capitalists. And he was actually the Harvard Business School dean. And there was another fellow, I forget his name, who was from MIT. So they really had the Boston roots. And things in the Boston area were going really well. They had put $70,000 as an investment into Digital Equipment Corporation, and that had grown to $350 million. And back then, that was huge money. Venture capital was
Still is good amount of money. 350 million, still a huge amount of money.
it was somewhat of a cottage industry back then. Venture capital really wasn't well known. But every time you would pick up a local paper in the Boston area back in the mid 80s, you'd read something about the father of venture capital, a Digital Equipment Corporation. And it was run by a fellow who was very personable, a fellow by the name of Ken Olsen, who started digital. He was kind of a homey type of person. And it was a good time to be in the Boston area. Things were really booming. So the company I went to work for was a networking company. Because again, at that time, computers had gone from mainframe to minis. Mainframes about the size of your living room, mini computers about the size of your bathroom. And that's what digital equipment did was mini computers. To personal computers, IBM had introduced the PC back about 1980, I think. And the forward-looking venture people were looking at, well, eventually these personal computers need to be talking to each other. There needs to be networking. And there was just a frenzy about investing in networking companies. And that's where I went to work for, was a networking company.
How did that eventually sort of lead you to the path of saying, we really need to like have a better startup tax and accounting firm?
I wanted to mitigate my risk. It was just my wife at the time. We didn't have a family. And I kind of looked around at the Boston area. And I come from Shell Oil Company, where you started with Shell and you retired with Shell. It was you stayed there forever. But in the Boston area, everyone's switching jobs every couple of years, and especially in startups. Startups are going under. So I'm thinking I'm going to have to be looking for a job every 2 or 3 years if I'm a full time CFO, and I don't have the resources to fund that. So it was actually to mitigate the risk. To mitigate that risk, I said that let me try doing something called part-time CFO. Now, nobody was doing it. I'm not sure if anyone on the West Coast was doing it. Certainly no one on the East Coast in the Boston area was doing part-time CFO. And I didn't even know what to call it. Fractional CFO. You gave it a whole bunch of different names. And so I had been probably 3 years with the networking company, and he had done a very large financing with some very top tier venture capital firms. And I had known a bunch of the big eight firms at that time. It was big eight, not big four, in the Boston area. And because we're switching auditors and all. And I thought maybe there's other firms that need someone to do CFO controllership work for startups on a part-time basis. And I kind of hung a shingle and never looked back. And I wanted to work for myself. I didn't want anyone working for me. I didn't want to work for anyone. I found out at Shell and at the networking company, I was a much better individual contributor than I was a manager. And so it worked out perfectly. The venture people understood it. The big eight auditors understood it. Lawyers understood it. Accountants didn't understand it at all. But plus, I'm doing value pricing. I'm doing fixed pricing and not doing hourly. They thought I was crazy and really kind of looked down on what I was trying to do. They like they say, just open up a local firm and do the YMCA's and the congressional churches, and you do just as well. They probably would have, but so I knew I wasn't getting rich doing that. But I never really looked back, and that was the start of Accountalent. It started 40 years ago, and it wasn't until probably 2008, when things hit and the financial crisis happened. And my kids at that point in time had grown up, and I was so sick of spending an hour and a half every morning driving to a client. There was no work from home back then. And at night, coming from Cambridge or Boston, a lot of times it'd be 2 hours. I'd get home at 7:30. You're a young family. It's just not, it doesn't work well. So I always liked the taxes. I always liked doing the taxes because my best clients when I was a CFO were what I call the living dead. They were the clients who got funded. You maybe did an A and a B round and lost their venture support and they went sideways. So now they didn't need a big H relationship to do their audit and they didn't need to spend all this money with a big H firm on doing the taxes. So I do the taxes. I charge them $1,000. Do the taxes was good money for me and I enjoy doing it. And when in doing the CFO work and what I was doing, the bad times were the best. So when the economy tanked, that's really when the best times were because you would get the most calls. I just fired my CFO. Can you come in a day a week? So those were absolutely the best times. So I'm looking 2008 saying, man, this is great. I just couldn't take the commute anymore. So I started doing some taxes. And again, totally lucky. The timing was perfect because the venture people really weren't invested all that much after 2008. They kind of put a hold on investment. But you had a lot of the angel investors, people who made money in the stock market, IPOs, things like that. And it just took off. It went crazy. It was just and I had to change the offering because I couldn't go in there on a monthly deal because you're basically just doing taxes. It wasn't bookkeeping or anything bad. It was just, I'll do your annual income taxes. And it just kind of worked out. But actually, where it worked out the best was on the West Coast. The founders they would just refer the heck out of you. It was crazy. The amount of referrals.
All right. So we have this sort of incubation. You're in Boston. That gives you this insight into the early days of venture capital. Fun fact, my conference room was Doriot in my last company. We named them after famous people and iconic people in industry. And actually, we were in not the Shell Oil, but we were in the Chevron Standard Oil headquarters at the time in my last company. So, all right. So then you get this startup explosion starts coming up with the dot-com boom. And you get this word of mouth virality. Paul Graham also started in Boston, NYC, and then moved over to the West Coast. So that makes sense. What was it specifically around startups? As you said, there's like startups are every 2 to 3 years. Like you just never know if they're going to exist. Why that niche versus, like you said, the nonprofits, local churches, community groups type thing?
Well, there's just so much capital creation and corporate formation in the startups. It's just, hundreds or thousands of companies getting formed every year. So you couldn't pick a better market. If you go into a market that, doing the YMCAs and the first congressional churches, is very limited. You're limited geographically. But, now with the internet and all, you're really not limited. And it's just a heck of a lot more interesting. You're dealing with younger people who are very innovative. They are very smart. They're very hardworking, regardless of what my generation says about them. They they are just a pleasure to work with. The founders of just all of the startups. They're respectful. So I just kind of fell in love with it, and it was just again, it was just luck.
Awesome. All right. Before we start diving into lessons learned, I can't let you off the hook of some of the stories that we've kind of talked about behind the scenes. Tell me a little bit about the flights from New York City on these penny IPOs down from Boston.
When I was doing CFO work, like I said, the people who really got it were the lawyers, the big aid audit partners, and the venture people. So one of the lawyers that I met, he was way ahead of his time. He had a pretty good sized firm in the Boston area. And he would take on these companies that had tough time getting financing. And he would come up with all kinds of innovative ways of financing them. One of the ways that he came up with was doing these IPO. And, this isn't Goldman Sachs IPOs. It's far from it. It's doing an IPO and getting $12 million, and probably paying 3 or 4 million of that in fees to the underwriter and everyone else who has a handout. So these are very small IPOs. And so I would go in as the part-time CFO and we would visit underwriters, mostly in New York, and we'd maybe visit 3 or 4 of them every time we go down there. We'd have a different deck, a pitch deck for each of them. This one kind of likes this one likes this one likes this. So we'd tailor it for them. And we would do the IPO. We'd do the S1 registration statement and, go through everything a regular IPO goes through. I think the thing that was most fun about it, because it was a lot of work and it was a pain dealing with the SEC. because it's very regulated doing an IPO, was probably the people that you met, especially the underwriters that you met. Met this one fella, Morty Davis, and he ran DH Blair, founded DH Blair. Now, Morty was a legend on Wall Street. He made a ton of money. And if you ever saw the movie or read the book, The Wolf of Wall Street, he modeled his firm after DH Blair. Now, what DH Blair did that was very smart was they didn't do penny IPOs because they'd price it at $10 rather than a penny. And they wouldn't go after the small individual investors. They go after rich people. And Morty made a killing. He's a very smart guy. It's just meeting people like that. That was a lot of fun because they were characters. They were just real characters. So
And then something else that in your past was about doing some expert witness or testimony in federal court in your CFO days. Any fun stories to share from them for those days?
yeah, that was a lot of fun. Again, the lawyers got it. The lawyers got this part-time CFO thing. And I met a lawyer out of Fish and Richardson at the time, was probably the largest IP firm in the country that was located in Boston. And she was a litigator. And I would get involved on doing some lost profit calculation, mostly for patent infringement cases. And those were a ton of fun too. I mean, they were long hours. You put a ton of effort into maybe 4 hours of testimony. But just to be in federal court, because they were all litigated in federal court, there was a lot of fun doing that. The one I had the most fun with, though, was there was a sculptor up in Vermont. And if you ever been to Washington, D.C., and you saw the Korean War Veterans Memorial, it's a memorial. It's on that National Mall, and I think there's 19 steel statues, and it depicts the different roles in the Korean War. When he got the contract from the government, they left out going ahead and sign over his IP rights. Now they realized that after he did the memorials and he got paid, and they came back to him and said, "Hey, look, we need you to sign over your IP rights." The guy was very smart. He said, "No, I'm not doing that." So, sure as anything, one of the statues end up on a stamp, a 37-cent stamp. It ends up that the U.S. Postal Service does. He sues them. He sues them for copyright infringement. The lawyer at Fish and Richardson that I dealt with took on the case. Now, when you sue the government, you don't sue them in a regular federal court. You sue them in a court called the Court of Federal Claims. So she sued him and she won on all counts except for the damages. The judge threw it out. She appealed it. The appeals court threw it back down to the Court of Federal Claims. Said, you got to pay this guy some damages because I think the damages they wanted to pay was only $5,000. So that's when I got involved when it went back to the Court of Federal Claims. And it was an interesting testimony because it's tough to say he lost any profits on it. He did it. And he wasn't selling it. It was copyright infringement. So what my testimony was how much can the Postal Service afford in damages? So it meant me going in for weeks, if not months, and just digging into the Postal Service's financial statement. And they do a fantastic job of issuing financial statements, and they're very thorough. So it was easy to get the financial information. And I did the testimony, and the Court of Federal Claims is kind of weird because the judges don't get a lifetime appointment. They get a 15-year appointment. Then they have to go in front of the Senate if they want to get re-up. And they're all bench trials. There's no jury here. So the judge is the jury. So she starts off in her opening remarks. And this judge is like just interrupting her, basically saying, you were full of crap before, and you're still full of it now. And every time the Department of Justice lawyer, would have an objection sustained, every time she'd have an objection overruled. But he ended up, bottom line, with about $700,000 a sculptor. But by that time, he was dead. So his family got it. So that was a lot of fun. Doing the expert witnessing was a lot of fun.
Oh man, I love hearing your stories and your background. It's so interesting. I learn something new every time.
Hey, we'll get back to the conversation in a moment after a word from our sponsors.
Let's transition this though, because we could talk about this for many more podcasts, into some of the actual lessons learned for founders. So the idea for this podcast originally came about because you were talking about a lesson that you were teaching again and again and again to founders, and this concept around a payroll medic that you were thinking about. Tell us a little bit more about what that means and why it came about.
Well, payroll has really improved over in my career because it used to be going to ADP or paychecks, which were terrible. Gusto and Rippling came out and they were really a breath of fresh air. But what happens oftentimes is that a founder will set up on Gusto and they're located in California. He or she needs to do a payroll registration in California, and they do that. But now they hire an employee in Washington or Oregon. You pick a state. And that's really when it starts going down because the registrations need to be done in order for Gusto or Rippling to remit the taxes. And then they start getting notices and to block your payroll. And what Gusto does is they just stop running payroll. They'll give you plenty of notice, though. Gusto's very good about giving you plenty of notice. Rippling fines you like $150 per paid period. And it just caused all kinds of stress. Now, no one wants to do payroll registration. There isn't, I don't think there's an accountant in the country who wants to do payroll registration. You're dealing with arcane systems. You just deal 50 different systems with 50 different states. It's awful. So what do you do though? We're the accountants. Yeah, we say we do your income taxes, but founders look at us as taxes, an umbrella. So we would always end up fixing it for them. And they were very grateful. Most of the time, we didn't even charge them for it. But I felt that the community, not just our clients, but the community, especially the small firms, needed something. So we're going to plan on doing what we call payroll medic. We'll help the startups, kind of get compliant. So Gusto's not shutting off their payroll or Rippling isn't finding them.
Love it. Actually, that's probably a good point to help frame. So, like you said, a lot of founders who aren't familiar with all the intricacies of taxes might come and say, all right, well, like they just blanket Joe or Accountalent or their local accountant as like, okay, well, it says the word taxes in there. Help frame the tax world for startup founders that don't have much exposure to this.
Well, they obviously need to file taxes. You formed an entity, it's like having a baby. You need to be compliant. You need to file income taxes. If you're selling stuff, you probably need to file sales tax. Where it's going to mess you up, not filing an income tax return, if you are a foreign founder or you're a foreign operation, then it's going to probably mess you up big time. Because if you're a 25% or greater foreign founders, and we're very blessed to have a lot of foreign founders in the startup community and they don't really know. They're coming from another country, another culture. But if they don't file an income tax return timely and they have transactions with their startup, there's a $25,000 fine. We get companies that they haven't filed in 3 or 4 years. Now there's 25, 25, 25, 25. It's terrible. A company that has very little capital, it stresses them out. So that's where taxes are gonna mess you up right there. The other place where tax is gonna mess up a startup founder is an 83B election. You miss an 83B election, there is no way to fix it. We used to see it at least once every year or two. A company would miss it and it would dissolve. They would dissolve and start over again because there's no easy way. But once you have financing, once you have some funding, it's tough to do that. And there's no easy way of getting around the 83B election. Issuing stock is also important. Yeah, I've seen it where someone waited. They waited way too long to issue stock. So now when you issue stock, you got to do it at fair market value. If not, it's a taxable event. So what happens, you do a $2 million financing, you get a 409A valuation, your company's worth $8 million. So, done. I need to get my stock, my founder stock. I need to get 20 or 30% of it. Well, 20 or 30% of $8 million, you need to pay for it now. Either that or you're stuck with options. So it's kind of in the intersection of law or legal and taxes where most of the stuff can get bad.
Right. So we have our federal taxes, which you got to file as soon as you have some state taxes. There's sales tax. We got payroll tax. We got 83. You got foreign registration. Are there other common mistakes that people make. You mentioned they just don't file them at all. Sometimes that's irreversible to fix in the future. You just can't fix an 83B election. There's fines. What are some other common mistakes that you see founders making?
It's probably like with bookkeeping. I understand the mentality of a startup founder. Yeah, product to market and not running out of cash trumps everything. So that is the most important thing. And they can easily keep track of not running out of cash by just looking at the bank website. But I think that things like bookkeeping are important because what it does, it gets you into a good habit. So you're starting off with good habits. My daughter told me something once. She said that the most important thing you do when you wake up is you make your bed. And because making your bed, you've now accomplished something. So now you're on a roll. You're accomplishing things and you feel good about yourself. And that goes to startup founders and bookkeeping. Go ahead and do the bookkeeping, do it early. It's going to be a lot more difficult getting it later. There's products now like Puzzle, where it's very easy to do your books yourself or get someone like us to help, very inexpensively. And it's a good habit. And they learn something too, which is a good thing.
One of the things that first caught my attention when I was learning about it was a product that you created called the Unbookkeeper for founders. What does the Unbookkeeper mean?
Unbookkeeper used to be probably 15 or 20 years ago when the cloud-based systems became popular. I would sit via Zoom with clients and I'd spend an hour or two with them and I'll set up the cloud-based bookkeeping system and try to put it on autopilot. And at that time we weren't offering bookkeeping services. And I would try to teach them because again, we're dealing with very bright, intelligent people here who know technology and teach them how to do it. And probably 50% of the times it worked out well. The entrepreneur, the founder would continue doing it. And until it got to a point where they grew so much that they couldn't. So that was unbookkeeper. You don't need a bookkeeper with unbookkeeper. So
And what were some of the, like, you'd have your introductory call, you would tell the bookkeeper, here, like, we'll set it up for you. You have to spend 20 minutes or 30 minutes or whatever the time frame is. What would you tactically actually do? And what would you ask the founder to do themselves?
well, on the call, I would have the founder setting it up, would be instructing he or she, and I would connect the bank accounts. I would connect the payroll and I'd show them how that works. Set up some rules. Every time you saw Delta Airlines, put it to air travel. And so the only thing that they would need to do would be to go ahead and accept any oddball transactions that we hadn't set up a rule for. They weren't going to do accrual-based accounting. They weren't going to go ahead and do deferred revenue or things like that. That wasn't going to happen. But it was good enough for them. And I think for a lot of them, it really taught them what a accounting system was. Like you said, I've done a lot of mentoring and office hours, and I do it over at Harvard. So the professor who teaches accounting, I think they have one course at Harvard Business School for accounting. He made an appointment with me, and he wanted to do on bookkeeper. And so I said, well, this guy knows what he's doing. He's a professor at Harvard. And the guy was amazed at the cloud-based accounting systems. He was like, and this goes back 10 years ago. I'm not talking 40 years ago. He was totally amazed at it. So he was saying, I can't believe this. I can't believe I didn't know any of this. He's a great guy too. Nice guy too. Nice guy.
There is this, like, lesson learned about what are the possibilities of the internet. And a lot of the core accounting systems were just built in the very earliest days of cloud. So, like, the concept of a bank feed is quite novel, and just getting the data in there, which is great. We've hired quite a few CPAs that worked at big four firms, and they come in and they know how to, like, be a skeptic at this GL line or the specific sort of like schedule. But, like, on a day to day, how to do accounting and how to manage books and set up for startups, like, it's a whole different skill set and world. Okay, so you go in, you set up a chart of accounts, you set up the bank feed, you have the founders go in. What's the expectation of time in the early days?
I would tell them 20 minutes a week.
20 minutes a week. Go in and just write down, categorize, or maybe write some memos.
Just go into the bank feed, see what wasn't accepted, either through a rule or an integration we set up, and just go ahead and accept it. If you pick the wrong thing category, who cares? Then we can fix it pretty easily.
And what this would do is one, create good habits early on in a startup's trajectory so that that moment that they do find that product market fit, that there's some semblance of like a quasi clean book, some blessed chart of accounts, like a best guess at categorization. How did this feed into the tax practice?
It helped us at the end of the year when we were doing the taxes. There was a set of books, and so we weren't getting a Excel download from Mercury or whatever bank they're using, and then we had to categorize everything. So at least some of the stuff was categorized. The other stuff that wasn't, we can fix it pretty easily. And once they did do another funding and they expanded and they got a bookkeeping firm, it was a lot easier, a lot cheaper for them to go ahead and transition to paid bookkeeping. So I think it helped them. It helped us too. I think though, what it really did, I think the real benefit was is that we're dealing with founders, and sometimes the first time founders, sometimes second or third time founders, but each startup for them should be a learning experience. They should take something from that startup, and now they're better equipped the next startup that they do. And I think that this helped them. This showed them this is an accounting system. This is how it works. And most of these founders are going to be their whole career. They're going to be founders. That's what they're going to do.
I found that there's a lot of skepticism amongst first time founders to get started doing accounting. It's sort of it's a future problem. As you mentioned, in the earliest days, you're just trying to build your product market fit. What are some of the either the lessons learned or the advice on how to convince early stage founders that this is important to prioritize even in the early days?
I think now when we're talking to a potential client, and I'm really not involved now with the management of the company. Son, JR, and managers that he hires has taken it over, and they're the ones who expanded it too. So it wasn't me who built this 5,000, 6,000 client company. It was them who expanded it. If it was me, it would just be myself, but it was them who expanded it. But when we talk to potential new clients, we emphasize bookkeeping to them. And now it's a little bit different. We don't have one bookkeeper. We have a paid bookkeeping, but our rates start very low. But for certain clients, I still end up doing it. Just yesterday I was doing it for a client, but not many though, because again, I'm not the one who's meeting with the clients initially. It's someone else, and it's better for the clients too, because if we can keep it very affordably, it's probably better for them to have some professional help. But I still like the learning aspect, the teaching aspect of sitting with them for an hour or two and showing them how to do it.
Do you find that probably somewhat of a self-selection of people that are reaching out to you guys anyway? Do you find that it's just like kind of a blocker? Like, I don't know how to take the first step. And so what you're really doing is saying, look, it's actually not that complicated in the early days. Here's like a set of chart of accounts. Here's the category. Here's the bank feed. Just go through and start categorizing. And that kind of helps bring a fairly complicated industry like accounting to something kind of simple and tactical. Or do you think there's something else?
I just think there's something. I just think that there's no desire to do it. They need to get product market fix, like you said, and they need to not run out of cash. And it just doesn't resonate. Taxes don't resonate with them. Yeah, what are we doing now? What's it, September? Is the beginning of September, and we have a bunch of tax returns we need to file because we would ask for information and we don't get it. We because taxes don't resonate with startup founders. So the community much better than I do. It's just like, okay, we'll start getting a lot of answers around October, beginning of October, because they do October 15th. But it is what it is. We've done it for so many years, and we're accustomed to it.
Yeah. Something that probably does resonate a lot more is something that you guys do and focus on, which is R&D tax credits. So tell us a little bit more about R&D tax credits for startup founders that might not have that much exposure to it.
Well, what a credit is, it's getting a second bite of the apple. So let's say that you hire a software engineer and you're paying that person $200,000. And so the first bite of the apple is you get to take that $200,000 as a tax deduction. And so it reduces your taxable income. It's just like buying office supplies is staple, same thing. Now, so that's the first bite of the apple. The second bite of the apple is able to take that $200,000 and throw it into an R&D credit as opposed to a deduction calculation, and you'll get 10% of that $200,000, $20,000 in cold hard cash for startups the first 5 years. The Gusto, the Rippling, whoever the payroll company is, will put it into the quarterly tax return and they'll receive a check from the IRS. It's obviously to go ahead and to encourage R&D in the US. And it's worked out well. We've gotten, again, cold hard cash, free money, non-dilutive money, over $100 million easily. Now, if you can't take the one that's refundable against payroll taxes, you can still take the R&D credit. We probably got 100 million of that also. So companies, after they've been around for 5 years, are beyond taking what's called the PATH Act refundable R&D credit. But everyone's planning on being profitable, so the R&D credit will reduce your taxes dollar for dollar. Like I said, it's two bites to the apple. It's crazy not to take it.
Do you think that people don't do it because they don't understand, there's not exposure, or actually are most people taking advantage of this?
I don't know. I just had a very large client, and they probably have six or $700,000 that said, no, we're not going to take it. I don't understand why. Yeah, so I'll make it really easy on you to take it. It's not going to take much of your time because you know what? You're not going to look good when this company transacts maybe with an asset purchase agreement, which is a taxable agreement, where you could have reduced those taxes dollar for dollar. Just do it. There's no downside. You're clearly doing R&D, no question about it. You have products out there, but you build the new stuff. I don't understand. It's beyond me why they don't take it.
Well, you've convinced me, and I appreciate it. It pays for another engineer. It's like a free engineer over the course of time, and some better quality swag. Get the branded swag instead of the cheaper stuff for puzzle employees. All right, I know we're running long, so if we look back over your decades of working with startup, what's one of the lessons that still resonates with you today that every founder should internalize?
Well, I think, like I said before, look at every startup that you do as a learner. Try to learn something. Try to learn something. Maybe it's about accounting and taxes. Maybe it's marketing. Maybe it's HR. Maybe if you're a business founder, it's something about software engineering. Try to learn something because that's going to help you in your next startup and startup after that. To treat the money that you've received from the founders like it's your own money. Yeah, go ahead and be prudent with that money. Obviously, they're investing in you because they want you to spend the money and they want you to spend it wisely. But spend it wisely. They don't. I see some of this stuff, and I won't get into details on that. But a lot of times it's posted over LinkedIn, the Hawaiian trips and things like it. It maybe I'm from a different era, but I'm not sure. But it just to me, I don't think that if your startup goes down and you have to deal with those investors. Are you going to be proud of what you did, how you spend that money? Yeah. Do stuff to make you proud.
We also talked a little bit about some of the lessons when you don't have a good accounting or tax strategy. So let's say you're a foreign founder and you don't file taxes and there's a penalty, or you don't file your 83B and there's kind of no second chances. Any stories on the other side of like memorable clients that captures the impact of good accounting and tax strategy?
Well, okay, we all say file your 83B election. But so you used to have a blog called 83B Elections for Dummies. And there'll be a pop up when you're reading it saying, if you want to discuss an 83B election, put my calendar link. And I get a lot of calls on that. I talk to a lot of people about 83B elections. So this guy calls me up and he's working for a publicly traded company, but very thinly traded company. And he went on there as VP of sales. And they gave him $3 million worth of stock. And this was a stock grant. It wasn't auctions. So they gave it to him. He had to pay for it. So he said, I did good. I filed my 83B election timely. And I said, okay, that's great. How much did you pay for the stock? I didn't pay anything for it. They gave it to me. Well done. Because you shouldn't, in that case, he shouldn't have filed an 83B election. Because now when he told me the 83B election, what he told the IRS is that I received $3 million worth of stock. I paid zero for it. And I'm putting into income this year $3 million of taxable income. So he's going to end up paying $1 million in taxes because of it. And so he never should have filed an 83B election. So, everyone who says file it religiously and all the time. No, that's not right. He should have waited, because what would have happened is that every time he vested, he would then be taxed on the appreciation there. And the appreciation is going to be based on he paying zero. So it's going to be total appreciation. But at least he probably could have sold some of the stock to pay the taxes. Now, like I said, it was very thinly traded stock. So he really couldn't sell everything up front. So I never heard from the guy. I felt so badly. I think he got advice from the company too to go ahead and to file the 83B election. So it was very unfortunate.
Always check with Joe before you do anything. All right. Well, for anybody listening out there where this is like, man, I need to learn more, or I haven't filed taxes, or you file into one of those, oh my God, where do people find out about Accountalent?
Well, they can go to our website, accountalent.com, one T in the middle. And if they want to find out any more, they can just send an email to info@accountalent, and that will go to me.
Awesome. Well, Joe, thank you so much for your time. Thank you for sharing some wisdom. It was a great time. I really appreciate it. Thank you.
All right, thank you for having me.
Thanks for listening to Tech Finance with Puzzle and Turpentine. If you got value from this episode, please share it with anybody building or funding the future of technology. And please leave us a review wherever you're listening and tell me about what you want to hear more of. If you're looking for accounting software you'll actually love to power your company, check out Puzzle.io, the modern accounting platform for the AI era. Tech Finance is part of Turpentine, the awesome podcast network behind Econ 102 with Noah Smith, Turpentine VC, Complex Systems with Patrick McKenzie, and so many more.